Micron dropped. SanDisk crashed 11%. And by the time the market closed today, institutional money had already bought back every single share retail investors panic sold, turning one of the ugliest red days in months into something that looked a lot more like an opportunity. Welcome back to Wealth Signal. Today we're breaking down the memory sector meltdown and why the panic might be the setup, not the story. Quick reminder before we dive in, this video is for education only. Nothing here is financial advice. Always do your own research before making any investment decision. Investing involves risk, including the possible loss of principal. Here's the question every memory investor needs answered tonight. Is the AI supercycle actually cracking, or did one headline out of China just trigger the biggest algorithmic overreaction we've seen all year? Today, Micron, SanDisk, SK Hynix, Western Digital, and Seagate all got hit at once. And if you only looked at the surface, it looked like the entire AI hardware trade was falling apart. I've gone through today's price action stock by stock, dug into the exact story out of China that triggered this, and pulled the block trades that show what institutional money actually did after the close. By the end of this video, you'll know whether this is a real crack in the memory thesis or the best entry window this sector has handed us in months. And if you're serious about tracking this sector with me week after week, hit subscribe now, because this week alone has 4 major earnings reports that could confirm or completely break this thesis. Composer, a $500 billion IPO on the other side of the world, couldn't move Micron's stock price in a single afternoon. You'd be wrong. A Chinese memory maker called CXMT went public today, instantly becoming China's most valuable listed company. And that single event dragged down not just memory stocks, but the entire AI hardware chain, from Nvidia to the equipment makers who build the machines. Zoom out for a second and look at the whole board, not just memory. The semiconductor sector fell over 3% today. Real, broad damage. But sitting right next to it on the same screen, the software sector actually climbed 2%. And consumer electronics barely moved, because that bucket is really just one company, Apple, which recently reclaimed the title of the world's most valuable company from Nvidia, and is walking into its own earnings on Thursday with real momentum. That contrast matters. This wasn't a technology is broken day. It was a chips and hardware day. So what actually triggered it? Not one story, 2 stacked on top of each other. The first is the IPO itself. CXMT flooding the market with a $500 billion debut, which, on its own, raises fears of a coming DRAM supply glut, plus a regional liquidity drain as Asian trading desks reportedly dumped other chip holdings just to chase the hottest listing on the STAR market this year. But the real story wasn't just the IPO. It was a second headline buried underneath it. A state-backed startup in Shanghai revealed it has started low-volume production of China's first domestic deep ultraviolet lithography machine, the kind of equipment used to manufacture advanced chips. They're targeting 5 machines this year, 20 by 2027. Small numbers today, but enough to spook the market into pricing in a future where China doesn't need Western equipment at all. Trading algorithms didn't wait to ask how realistic that future actually is. They just sold. Nvidia and AMD both dropped roughly 5%. ASML fell 6%, and equipment makers like Applied Materials and Lam Research got dragged down with them, even though none of them lost a single customer today. That's the tell. When a 5-machine pilot program in Shanghai wipes billions off companies that have nothing to do with it, you're not looking at a fundamental story. You're looking at a headline moving faster than the facts underneath it. And underneath all of it, there's a macro backdrop that's genuinely tightening the screws. Oil prices are climbing. Treasury yields are pushing higher on fears that rate cuts are further away than hoped. The Fed meets Wednesday, and after Google's own earnings showed rising CapEx alongside negative free cash flow, the market has turned deeply skeptical about whether all this AI infrastructure spending is actually generating a fast enough return. That skepticism is exactly why hedge funds are quietly de-risking high-beta memory names right into this week's hyperscaler earnings. If you're finding this breakdown useful so far, drop a like. It genuinely helps this channel more than you'd think. Zoom back in on the memory names themselves, and the damage wasn't spread evenly. Micron only fell about 2.25%, mild compared to what came next. SanDisk, a high-beta stock that swung from over $2,000 a share down to around $1,200 to $1,300, crashed 11%. SK Hynix's ADR dropped 7.5%, and both Western Digital and Seagate, the storage side of this trade, fell about 4% each. This was the Fab Five of memory and storage, all bleeding on the same afternoon. Now imagine you were watching Micron's chart live today. It gapped up at the open, climbed to an intraday high of $934.92, then got flushed all the way down to $854 as the China headlines hit. If you're a chartist, that's exactly the level where the stock should have kept falling towards $750. Instead, something else happened. The stock stopped falling at $854, then printed a series of higher highs, 881, then 887, then 897, before finishing the day back above $900. That's not random noise. Roughly 80% of Micron's shares are held by institutions, and the block trades right after the closing bell tell the real story. A $2.5 million trade at the close, then $135 million 14 seconds later, then a $600 million trade, then over $200 million more, all within the first 15 minutes after hours. Picture two investors watching the same chart at 2 p.m. One panics at $854 and sells into the fear. The other watches the tape, sees the institutional buying build underneath the price, and holds. Only one of them is still in the trade tonight, and smart money just used retail panic to build what looks like a concrete floor at $900. The options market backs this up too. Implied volatility actually came down slightly after the drop. The put-to-call ratio dropped below 1 after tracking above 1.3 last week, and the market's expected range for Micron over the coming days sits between roughly $850 and $951, with $850 lining up almost exactly with today's intraday low. Before we move on, everything I've referenced visually in this video is saved as a downloadable summary file in our Wealth Signal Telegram channel, along with every past and future videos file. Links in the description. Go grab it.
Quick comment prompt. Tell me down below, are you buying this dip or waiting for earnings first?
While Micron was fighting its way back from $854, a much bigger story was quietly rewriting the balance of power in the memory market. Samsung, the company everyone assumed was falling behind SK Hynix in the HBM race, just signed 3 separate deals that could put it right back in the center of the AI memory story. Remember, this comes right on the heels of Nvidia and SK Hynix announcing their own partnership at a summit last week. So this isn't Samsung making noise in a vacuum. It's Samsung answering, deal for deal, in real time. And that matters for how you think about Micron and SK Hynix specifically. Renewed competition from Samsung at the high end of HBM4 could compress the pricing power both companies have been enjoying, even if none of their current contracts are actually at risk. First, Samsung and Broadcom announced an expanded partnership expected to exceed $200 billion over 5 years through 2030, covering both memory and foundry work, though it's a memorandum of understanding, not a signed purchase contract yet. Then, Samsung confirmed it would supply HBM4 memory for both AMD's next-generation accelerators and OpenAI's first in-house AI chip, with talks reportedly moving from framework agreements toward final commercial terms. Add that on top of Nvidia's roughly $500 billion supply deal with SK Hynix and Micron's own agreements, and you're looking at something close to $700 billion in memory supply commitments across the industry. That number tells you something the stock chart can't. Right now, locking up physical memory supply matters more to hyperscalers than locking up compute power. Here's the part most people are missing while they panic over one Chinese headline. This week is arguably the single biggest stress test the memory sector has faced all year, and it has nothing to do with China at all. 4 companies report this week, and between them, they'll either confirm every green signal we just walked through or hand the bears real ammunition. Think of it like a relay race. If one runner stumbles, the whole team's time still looks bad, even if the other 3 ran their best race ever. That's exactly the risk hanging over the memory sector right now. Seagate reports tomorrow, and the bar is real. Over $3.5 billion in revenue, EPS above $5.10, and confirmation that hard drive demand, gross margins, and full-year 2027 guidance are all still moving in the right direction. SK Hynix needs to beat $57.6 billion in revenue, with operating margins near a record 75 to 77%, alongside strong HBM4 guidance. Samsung reports its full earnings on July 30th, and the number that actually matters is buried inside it. Analysts expect its semiconductor division alone to drive 90 to 94% of total operating profit. And Kioxia needs to clear $8.2 billion in operating profit with 74% margins, backed by disciplined supply and rising NAND prices. If all 5 signals across these 4 companies come in clean, the AI memory supercycle thesis gets stronger than it's ever been. If multiple names miss, we could see real multiple compression across the entire sector, which is exactly why this week matters more than any single headline out of China. So let's go back to the question we opened with. Is this a real crack or a headline shakeout? Pulling every signal together, the green ones, the yellow ones, and the red ones, gives us the clearest answer of the day. Think of today less as one single signal and more as 3 different weather systems colliding at the same time. Real macro pressure, real competitive shifts inside the sector, and a genuine liquidity shock from China, all landing on the same afternoon. Pulling them apart one at a time is the only way to actually judge what happened, instead of reacting to how loud the red candles looked on your screen. On the red side, rising oil, climbing treasury yields, a Fed meeting Wednesday, and hedge funds visibly de-risking ahead of hyperscaler earnings. On the yellow side, this week's memory earnings gauntlet and Samsung's resurgence putting real competitive pressure on Micron and SK Hynix. But on the green side, institutional buying that built a real floor under Micron, $700 billion in binding supply commitments, and a Chinese lithography threat that's still years away from mattering at scale. Putting it all together, this sits at a 7.2 out of 10 on our conviction scale. High confidence, but real volatility to respect. The lesson isn't to chase every red candle or every green one. It's to know the difference between a business breaking and a market having a bad afternoon. This is my read based on the research. Your situation and risk tolerance might be different, so always do your own homework before investing. If this breakdown helped you see today's drop differently, hit like. It tells YouTube to show this to more investors who need it. Subscribe with notifications on, because we're tracking every one of this week's earnings together. And drop a comment. Which of these 4 earnings reports are you watching closest? And if you want the visual summary file for this video, join the Wealth Signal Telegram channel. Link is in the description. Next week, we'll be back to see whether these earnings confirmed the supercycle or broke it. I'm Alex Carter, and I'll see you in the next one.